Hello, this is Lara at Elliott Wave Stock Market with your end of the week analysis for the S&P 500 for the trading week ending Friday 28th of May 2021. The trend for the S&P remains up. It looks like it's in a little consolidation. If we can see a close next week above the prior all-time high on an upward day with support from volume, that would constitute an upward breakout, and then we may see some increase in upward momentum. But for now, we might see another downward swing within this consolidation. For the short term, there is resistance at 4238 and support at 4058. And for the short term, while price remains above 4182.52, it's most likely an upward breakout may occur sooner rather than later. However, if we see a new low below 4182.52, that may indicate a downward swing is underway. Look out for support either 4177 or 4155. Elliott Wave analysis first, classic analysis last. At the weekly chart level, this is the Elliott Wave count, which sees a fifth wave at cycle degree beginning here. If this ends in 2029, for Super Cycle 5 to end Grand Super Cycle Wave 1, then within Cycle 5, Primary Wave 1 may be incomplete. A cycle degree wave should last from 1 to several years, and so a duration here from 2020 to 2029 being about 9 years in duration, that's absolutely what would be expected for cycle degree waves. This particular market, though, has a strong bullish bias, and so for bullish waves, they can be a long extensions and can last a lot longer than those guidelines outline. The structure of Super Cycle Wave 5 must be a 5-wave motive structure, either an ending diagonal or an impulse, and of those two, an impulse is much more likely because they are much more common. Within it, I have Primary Wave 1 incomplete and subdividing as an impulse with intermediate 1, 2, intermediate 3 incomplete, and the target for intermediate 3 is for it to reach the most common Fibonacci ratio, 1.618, the length of intermediate 1 at 5469. Intermediate 3 may only subdivide as an impulse. Within it, I have minor waves 1 and 2 over here, minor wave 3 incomplete. When minor wave 4 arrives, it may not move into minor wave 1 price territory, and then minor wave 5 may take price up to this target. But when I know where minor waves 3 and 4 have ended, then I will use Fibonacci ratios between minor waves 1, 3 and 5 to add to this target calculation at a second degree. So as we get closer to the end of intermediate 3, I will be able to add to the target calculation at minor degree, and then even closer, minute, and so on and so forth. My methodology here is to refine the target to a small zone with a confluence or a cluster of different calculations at different degrees to have the highest probability I can get for you. So this target may widen to a small zone or it may change. When intermediate 3 is complete, then a multi-week consolidation or pullback for intermediate 4 may not move into intermediate wave 1 price territory below 3588.11. When primary wave 1 in its entirety is complete, then a multi-month pullback or consolidation for primary 2 would be expected. It could be deep, and it could technically meet the definition of a bear market in a 20% or more drop in market value. But primary wave 2, when it arrives, may not move beyond the start of primary 1 below 2191.86. When it arrives eventually, it may resolve a lot of bearishness that's out there. This wave count sees a middle of a third wave past here, and it does have a little bit of an increase in slope and a nice little curved look to it, and that fits. At the daily chart level, we're now zooming in on minor wave 3 just real quick. From this low down here, the end of minor 2 and the start of minor 3, this is this point here on the daily chart. Minor wave 3 is shaping up to look like a really normal looking impulse with minute 1, a zigzag for 2, 3, an expanded flat for 4, perfect alternation, and 5 unfolding. My target for minor 3 to end is again using the most common Fibonacci ratio for it to reach 1.618, the length of minor wave 1 at 4,900. In order for that target to be met, minute wave 5 may be a long extension. That's absolutely acceptable because minute wave 1 is not extended. Minute wave 3 is extended. Minute wave 5 may also be extended. Within minute wave 5, no second wave correction may move beyond its start below 4056.68, but any corrections along the way up shouldn't get too close to this point because we may find support at the lower edge of this Elliott channel. Draw this from the end of minute 2 to 4, place a parallel copy on the end of 3. Look out for support with possible overshoots like we saw here, that's again possible. Look out for support though at the lower edge of this channel if price gets down that low. At the hourly chart level, here's the end of subminuet 2, which you can see on the daily chart. It's that little overshoot of the lower edge of the Elliott channel. That's the end of 2, and so the start of subminuet wave 3, with micro 1 and 2 most likely looks complete, micro 3 beginning with a leading contracting diagonal for submicro 1, and a now little zigzag for submicro 2 could be over at Friday's low, or it could also certainly move lower on Tuesday when markets open. Monday is closed for Memorial Day, so submicro 2 may not move beyond the start of submicro 1 below 4182.52. And here's the lower edge of that channel, which should provide support. If we move the degree of labelling here down 1 degree, it's possible we can see submicro 2 incomplete. It's all the same from this high here of submicro 1. And now the hourly alternate wave count considers submicro 2 continuing further as an expanded flat correction, subdividing 3, 3, 5, labelled A, B, C. A is a double zigzag that is classified as a corrective Elliott wave structure. A waves within flat corrections can be any corrective structure except a triangle. They can most certainly be multiple zigzags. B may also be a double zigzag. C would now need to move lower, subdividing as a 5-wave structure, and the most common Fibonacci ratio for wave C within an expanded flat is for it to reach 1.618, the length of A, at 4168. That doesn't coincide with any of the Fibonacci ratios for microwave 1, but this would be the preferred target for micro 2. If it falls through that target though, then I'd look out for the 0.382 Fibonacci ratio at 4155.35 to possibly be where it ends, and if it falls through that, then I'd expect the lower edge of that Elliott channel to again provide support. Targets for minor 3 and intermediate 3 on this chart are exactly the same. This month, let's take a step back and take a look at the monthly chart. We're going back quite a long way. We're going back, I think this is 11 years of data on a monthly chart. I keep telling you that when we see upward movement on light and declining volume, I'm not concerned, because if you look at this chart, you can see that that's been sustained repeatedly for a period now of years. And you can go back to March 2009, the beginning of this huge bull market, and see again, even off to the left of the chart, that's further sustained. And so all the textbooks tell us that this shouldn't be happening, and it shouldn't be happening for years and years and years, but pretty obviously it is. I think what this means is eventually this bull market will end, and there will be a bear market, as sure as night follows day. Eventually it will happen. The question is when. When it does happen, volume below is quite light, so support below is very thin, and eventually when a bear market arrives, it could fall really, really fast, even faster than usual for this market. But we are not there yet. So apart from declining volume, this chart looks pretty healthy. RSI is overbought, but for this market with its strong bullish bias, that can be sustained for actually years, and it can get very overbought. I do not see at this point of time short-term swing high divergence between price and RSI like we saw back here. Well, we saw it back here and it resulted in this, and then we saw it again here, but it only resulted in pretty much just over a week of an inside downward week, back to this triple divergence here. And so I'm not going to read this divergence from here to here. I'm going to be looking for this short-term setup before I expect that will, well, shorter term on the monthly chart that is, it's actually quite a long term, but divergence between swing highs. So if we see a pullback on the monthly chart and then a new high, and then we see divergence between that, that's when I'm going to start to count it, like this situation back here. But it doesn't always work, because we saw it back to here You could see triple divergence and it didn't really result in much. So that's an instance where the divergence, if you wanted to count it here on this month here, did not result in much of a bearish movement at all. On balance volume is confirming new highs in price. It's got a fairly long held resistance line here that it's very, very close to, but this line has a bit of a slope, so it doesn't have strong technical significance, but it's got multiple tests and it's long held, so it has some reasonable technical significance. If we saw you break above that, that would be a pretty reasonable bullish signal. ADX is moving up and it's above 15. It's below the positive DX line. This looks like a healthy bull market in a relatively early stage. This is not extreme, this is only just extreme. So between these two, it's not telling us that the bull market has to end. ATR is now flattening off as price moves higher. Absolutely normal behavior for this market, not of a concern at all. At the weekly chart level this week, we have a higher high and a higher low. We have a green weekly candlestick. It's pretty small, but I think that could be because price is in a little consolidation with resistance about the prior all-time high and support at these lows on these bullish long lower wicks. Upwards movement this week does have a wee push from volume. The bearish signal I noted from on-balance volume this week was negated, so I've had to redraw the line. This is a support line, but it's very weak because it's only got the minimum required 2 anchor points to draw the line. It doesn't have good technical significance, so no signal this week from on-balance volume. RSI is in neutral territory. There's no short-term divergence. ADX is declining, and it's above both DX lines, so at this time frame it's not indicating a clear trend. MACD gives us a bearish crossover. This is one of the few bearish points on the chart, but it's overwhelmed. ATR is declining as well, that's normal. It's overwhelmed overall by bullishness. There is a series from March 2020 of higher highs and higher lows, and it just keeps continuing. The last swing low back here still remains intact. It looks like price is most likely in another consolidation, a normal and to be expected part of an ongoing bullish trend. I am expecting an upward breakout as most likely. One of my maxims is the trend remains the same until proven otherwise. Apart from this gravestone doji here, there is no, well, I guess you could count this as a hanging man candlestick pattern. So you could count 2 bearish candlestick patterns there, not particularly strong ones though. What other bearishness can I see? The MACD crossover. That's it. This chart looks overly bullish and there is a trend. It's an upward trend. Assume it remains the same until proven otherwise. Proven otherwise, at the very least, would be a new swing low, a lower low, below this prior swing low. At the daily chart level, we had a hanging man here. It could be resolved by a few days of downward movement. We have what could be a bearish engulfing candlestick pattern, although it doesn't actually fully engulf this prior real body of this candlestick, but it is a fairly bearish pattern. We had another couple of downward days, an 80% downward day here, and then an 80% upward day here. Normal and to be expected increase in volatility and extremes within the context of this consolidation. Upward movement for the last 3 sessions is really anemic. It may be being held back by resistance at the prior all-time high at 4238. But in this session here for Thursday, it was small caps that had quite a surge of upward movement within this session. This session completed a red doji, but the percentage of up volume to total up-down volume was 77%, so up volume dominated, and we will look deeper into that. It was small caps that dominated this with a surge on Thursday, so that's bullish for the short term. ADX reached extreme, just reached extreme here for this upward trend. It's now declining as price is moving sideways, telling us there's no clear trend at the moment. The positive DX line has again crossed above the negative, so we had a negative cross here and we've got a positive cross here. If ADX again increases, and it's pretty close to 15, it would again indicate an upward trend, but right now it indicates no clear trend and price is consolidating with resistance here and support here. ATR is declining as price moves higher within this upward swing within the consolidation. Normal to be expected behavior. The last signal from on balance volume was bullish. Not a particularly strong one, but it is a bullish signal. No new signal at the end of the week from on-balance volume. This consolidation may have now resolved this double bearish short-term divergence from price and RSI, and now there may be room again, well, there is room again for the upward trend, the larger trend to continue. RSI is well and neutral, and this consolidation has brought ADX well down from extreme. It's now well below both DX lines. MACD at the daily chart level gives us a bullish crossover, stochastics entering overbought. So with no clear trend and stochastics entering overbought and price very near resistance, it would be a reasonable expectation to now see a downward swing if the consolidation continues. But if we see a close or a new all-time high on a closing basis, that would constitute an upward breakout, and then we can be confident that the upward trend is resuming. We don't have that yet, but what we do have from the AD line is new all-time highs, and so this is a really strong and really quite a reliable signal. It doesn't always work, but it does work much more often than it fails. When the AD line leads, price usually follows. The AD line at the weekly chart level is making new all-time highs. That is very bullish for price and indicates an upward breakout from the consolidation is likely to come sooner rather than later. At the daily chart level for the last 3 sessions in a row, the AD line has made new all-time highs. Price hasn't yet made new all-time highs. This happened back here. We got an upward breakout, normal to be expected pullback, more upward movement. It's happening again. Let's expect an upward breakout. Doesn't mean we can't have another pullback or consolidation, and the Elliott Wave structure will outline how and when that may look. Price and inverted VIX, both price and inverted VIX moved higher this week. Neither have made new all-time highs. Inverted VIX hasn't made a new short-term high. No new divergence here. Both VIX and VVIX have moved lower this week. No new divergence there. At the daily chart level, price has moved higher for Friday, but it closed red, and it's a really small range, weak, anemic candlestick. Inverted VIX is essentially flat. This is just not a great enough difference for me to consider this divergence and make it a point of it at all, so I'll say it isn't. Both VIX and VVIX are moving higher. VIX and VVIX both moving higher for Friday. No new short-term divergence. We had mid-term bearish divergence here between these highs of VIX and VVIX. And I think that may now be resolved by them both moving lower, and now they're both showing us short-term bullish divergence. So that would tend to support the Elliott Wave count. That is all from me at the end of the week with your S&P analysis, and I hope that all of our members are having a fabulous and happy weekend.